And now, Lifestyles Unlimited presents the Real Estate Investor Radio Show. Over the next hour, we unfold your map to financial freedom. You'll learn how to retire through investing in single-family and multifamily real estate. You'll learn how to create cash flow and build wealth so you can have the time and money to live the lifestyle you want.
Welcome to the show. My name is Al Gordon, and as always, I'm working on your financial freedom. And on today's show, we're going to reflect on what I talked about on yesterday's show because I didn't give you all the information you were looking for. Trust me, I had a lot of things going on yesterday. I had a lot of content that I had to cover. And most importantly, I was more interested in explaining to you how you could take $50,000 of your own money and put it into the stock market and let it sit there for 5 years, and hopefully it would go up in value, and that $50,000 would turn into $80,000. And then I compared it to what you could do if you just bought 3 single-family assets with that $50,000, and you let those assets mature over a 5-year period of time, and that would result in you turning $50,000 into $224,000. And when you look at rates of return, the rates of return for the stock market would have been a 60% overall rate of return, which isn't bad, but it's not great when you compare it to real estate investing, which would get you a 369% rate of return over a 5-year period. I'm going to hit you with more information today because that's part of the reason you've tuned in is you want information. You want to understand how this real estate investing can benefit you and get you to a place of retirement in 5 years or less. So what I'm going to do, first of all, is I'm going to remind you that all of our radio shows, if you're listening to me live on the radio, all of our radio shows are repurposed into podcasts. So how do you get access to these podcasts? Well, there's a couple ways you can do it. The easiest way is to go to lifestylesunlimited.com. When you get there, click on the radio tab. It may say podcast. It depends on how you're accessing the site. And what that's going to give you is access to all of our radio shows. They all get repurposed as podcasts, and they get stored on our website. Now, it does take a day or two for the radio shows to get processed and for all the smart people that do all the smart things in the background to do whatever they need to do for that show to actually arrive there. So you may have to wait a day or so in order to get access to yesterday's show. But I will tell you, there's a lot of great content on yesterday's show, content that I'm not going to repeat on today's show. But even if you didn't catch yesterday's show, not a problem. You know what? I forgot to tell you the other way. I just realized I forgot to tell you the other way that you can access the Lifestyles Unlimited Real Estate Investor Radio Show. And that's simply to go to wherever you get your podcasts from. Now, I subscribe to a service, so I just type in Lifestyles Unlimited, and it gives me access to all of the Lifestyles Unlimited Real Estate Investor Radio Show shows, and it also gives me access to the Del Walmsley Radio Show. So together, between those two shows, you get 10 different episodes of radio per week. And if you want to educate yourself, what you need to do is you need to tap in to those podcasts. Go back and listen to stuff that we put out a month ago or maybe 2 months ago. Or maybe you're just behind and you want to get caught up. Not a problem. Get caught up. All right, so now that I've gotten caught up with you, I'm going to get back into the content that I want to talk to you about today that I never had a chance to talk to you about yesterday because I only have so much time on the radio shows. So here's what I want to talk about. Yesterday, I pointed out to you that there were 3 different assets that came into my inbox, and if you bought all 3 of those assets, it would cost you $50,000 to buy those assets. So where did I get those numbers from? I got those numbers from doing an analysis of the basic components of the deals that came into my inbox. Now, I didn't go searching through my inbox looking for, well, I've got to find a particular thing or I've got to find a particular number. I didn't do that. I took the latest 3 properties that came into my inbox. Now, one of the properties is located in San Antonio, Texas. We'll call it property number 1. It was built in 1925. It exists in the current market space as a 2-bedroom, 1-bath property. It's a little over 700 square feet. Property number 2 is in the Kansas City, Missouri market. It was built in 1950. It's a 3-bedroom, 1-bath property, and it's 1,360 square feet. Now, property number 3 is in Springfield, Missouri, was built in 1932. It is a 2-bedroom, 1-bath, and it is currently, I've got to look it up here because my spreadsheet's not aligning correctly, it's currently 720 square feet. It's just a 2-bedroom, 1-bath property. It's 720 square feet by the assessor's office, and it's not real big. It's about the size of most apartment units today. The difference being it's not an apartment. It's a house. It's a house that sits on its own piece of land that has a yard around it. It has a driveway in front of it. It has street parking in front of it. It is completely different than an apartment, yet it's about the same size. One of his concerns was, but it's tiny. Here's the way you have to look at it. You have to look at it from the lens of the people that are going to rent the property. Now, you think about it. Where are the people living that are looking at this 720 square foot house to potentially rent? They're probably living in a 2-bedroom, 1-bath apartment that's probably right around 720 square feet. So they're used to having that type of square footage as far as their amenity for their home. So looking at a house that's only 720 square feet may not be a deal killer for them because size-wise, it's what they're comfortable with. But here's the other thing you need to look at. Maybe a 2-bedroom, 1-bath property, maybe that's not the appropriate size for that particular asset. During the rehab process, you may determine that that property would be better suited becoming a 3-bedroom, 1-bath, or possibly a 3-bedroom, 2-bath property. So what you have to do is when you analyze these properties, you have to analyze them based on the fact that maybe you need to upgrade them as far as size, or maybe you have to add a bedroom, or maybe you have to add a bathroom to make them more amenable. I don't even know if that's the correct word, in the market where the property exists. So let's put it this way. You're looking at a 2-bedroom, 1-bath property that you want to buy. In the neighborhood around it, it's dominated primarily by 3-bedroom, 2-bath property. Do you think your property would have a handicap competing against 3-bedroom, 2-bath properties in that particular neighborhood? Now, some people would tell you, yes, it would have a handicap. And what you need to do is you need to add that extra bedroom. You have to add that extra bathroom to make that property competitive. But here's the thing. You only add those things if, number one, it makes sense to add those things, and number two, if it is cost effective to add those things. If it's neither of those things and that property won't be competitive in that marketplace, maybe you walk away from that property. Does that make sense? I know that makes sense to you. But what I want to do is I want to analyze all 3 of these different properties because I want you to get an understanding of why I didn't disregard any of these properties yesterday when I was considering them for properties that I would put into a portfolio where I have $50,000 that I want to spend on real estate. Now, I could put the $50,000 in the stock market. I mean, that's a viable course of action. But the rates of return that I receive in the stock market are not as beneficial to me and my retirement strategy as they are by putting them in to the real estate market. So let's go back to property number 1. Again, property number 1 is the smallest of all 3 properties. I mean, we were just kind of talking about property number 3 being at 720 square feet. Well, property number 1 is only at 701 square feet. It has 2 bedrooms. It has 1 bath. It was built in 1925. This property is 99 years of age. Now, that might scare some people, but I will tell you, when you become a Lifestyles Unlimited member, age of properties will not scare you. There are some things that you need to take into consideration regarding the fact that this property is almost 100 years of age, such as the building codes. The building codes in San Antonio, Texas, 100 years ago, they didn't really exist. There really weren't any building codes in the city of San Antonio. So whatever the builder did back in, say 100 years ago, was what the builder did. Now, I'm not saying that builders from 100 years ago cut corners, But what I am saying is that there were no standards for them to be measured up against. So, at the end of the day, let the buyer beware, right? But the fact that that property is still standing there almost 100 years later is a testament to at least the strength of the building materials that went into that property. That property's been around for 100 years. Now, mechanically, it might be a little bit different. Mechanically, over the years, people may have improved the property. For instance, HVAC didn't exist 100 years ago. That's kind of a more modern improvement that's been made to properties. So this particular property, from what I can tell, it does have HVAC, but that HVAC system is kind of old. It's kind of tired. It's probably going to need to be changed out. So you have to build those numbers into your repair costs. So let's talk a little bit more about property number one, because if the age doesn't scare you away, and the size doesn't scare you away, and the fact that maybe you need to add potentially another bedroom or potentially another bathroom or potentially both to the property, if neither of those things scares you away, then what you really want to do is you want to look at the underlying numbers. Now, the after repair value of this property, in other words, all fixed up, is worth $175,000. That means in today's day and age, a property of that size, of that square footage, when all fixed up, when modernized, is worth $175,000 in today's market. But that property is not modernized. It has not been all fixed up. There are some things wrong with that property, which allows us to buy that property for $87,000. In other words, we're buying that property for literally 50 cents on the dollar. And with that, we're going to assess our repairs at $48,000. Those are the estimates that I came up with, and that includes converting this property from a 2-bedroom, 1-bath to a 3-bedroom, 2-bath. There are costs that I've built into that $48,000 rehab expense that adds that 3rd bedroom and that 2nd bathroom. Now, you're going to have closing and holding costs of about $10,000, but when the dust all settles, you're going to have net equity captured of about $30,000. And now get this, you don't have to spend your entire $50,000 on this particular property. By taking advantage of a hard money loan, your cash out of pocket is going to be right in the neighborhood of $17,500. So you're going to get now get this, with a net equity of $30,000 captured, that's the additional equity you're capturing in this property over and above the $17,500 you're physically putting in, you're getting a return on capital gains of 171%. That is a very excellent number, 171%. Now, you're also getting cash flow in this property, and the cash flow comes in right at around $207 per month. When you annualize that cash flow amount, you're getting cash flow on an annual basis of $2,484. It's giving you over 14% return on investment just on the cash flow. Now, these are some of the ways that we analyze properties. And when we come back from the break, I'm going to talk to you about properties number 2 and properties number 3. Stick around.
Got questions? Call Lifestyles Unlimited at 855-497-4335. The Real Estate Investor Radio Show continues next.
Want to retire in 5 years or less? You can do it. Want to build wealth impacting your family for generations? Bill Walmsley and his Lifestyles Unlimited team are educating folks just like you how to become real estate retired, even winning awards like Chad and Lisa.
This property, for you to have done what you've done, won the award, changed it around, done all the rehab, has got to be worth a lot more.
Well, we purchased it for $8.275, and it's worth $19 million now. So
wait, whoa. That is incredible. I can see why you won an award, and that's great.
With over 33 years teaching real people the roadmap to real estate retiring, we want to meet you. Join Lifestyles Unlimited with this introductory offer. 2 years for $297. The Lifestyles Unlimited Financial Freedom Program. Go to GiveMeTotalFreedom.com. GiveMeTotalFreedom.com. Enter code 2024. Join and learn with Lifestyles Unlimited at GiveMeTotalFreedom.com. Code 2024.
Creating the lifestyle you've always wanted. You're hearing Lifestyles Unlimited's Real Estate Investor Radio Show.
Welcome back to the second half of the Lifestyles Unlimited Real Estate Investor Radio Show. My name is Al Gordon, and as always, I am working on your financial freedom. And on today's show, what I'm going to do is I'm going to get back into some of the properties that I talked about yesterday because I want you to have more information. I want you to understand how I analyze those properties and how I felt those properties would be beneficial to potentially me or anybody else that might consider buying these properties, because what these properties do for you is they give you a better rate of return than what you're getting in the stock market. So we talked about property number one, which was a property in the San Antonio market built in 1925. It's a 2-bedroom, 1-bath, 701 square feet. Now that would scare some people, but at the end of the day, it doesn't scare me. Even though I haven't physically stepped foot in this property, what I am doing is I am analyzing this property and I'm giving you that feedback on what this property can do for you. And just to recap a little bit, this particular property would cost me $17,500 out of my own pocket. It would allow me to capture an additional $30,000 in equity in the property. That's free equity that I don't have to pay for. And that would give me a return on capital gain of about 171%. In addition to that equity capture, the property is going to produce cash flow in the neighborhood of $207 per month. When you annualize that cash flow, that turns out to be $2,484 per year. And when you divide that by the cash out of pocket of $17,500, that gives me a cash on cash return of a little bit over 14% return on investment. Okay, so those are two primary evaluators that I use to determine whether or not I will consider properties to put in my portfolio. Now, there were two other properties that we talked about briefly on yesterday's show. Property number 2 is in a completely different place. It's in Kansas City, Missouri, and it was built in 1950. So it's a little bit more modern than property number 1. It's got 25 years youngness compared to that 1925 property, but it's still built in 1950. It's still a property that's older than I am. Now, this particular property is a 3-bedroom, 1-bath, and it's 1,360 square feet, so it's a little bit bigger in size. The after repair value of this property, in other words, when all fixed up, 3-bedroom, 1-bath properties in that particular neighborhood are trading for $165,000. Now, we can buy this property because of, well, there's a myriad of reasons why, but it's primarily deferred maintenance on this particular property. We can pay for the property only $72,000. That represents about a 44 cents on the dollar purchase price, which I like. Anytime I can buy a property for less than 50 cents on the dollar based on what it's realistically worth, I know I have the potential to make money with that property. Now, rehab-wise on this property, it's going to cost a little bit more money to do the rehab on the property, partially because it's a bigger property and partially because it has more things potentially wrong with it than property number 1. So my rehab dollars came in at $58,500 plus an additional $10,000 worth of closing and holding costs. So what that does for me is it allows me to capture net equity in the property of $24,500. That's additional equity that I don't pay for in the property. Now, you're probably screaming at the radio, okay, what's the cash out of pocket, Al? You didn't tell us how much you're actually putting in the deal. You're right, I didn't, so I'm going to tell you that right now. I'm putting $22,000 of my own money into the deal. And by capturing $24,500 of additional equity, I'm getting a 111% return on the capital gains. Now, on property number 2, the return on the capital gains at 111% isn't as good as the return on capital gains of property number 1 at 171%, but I'm still doubling my money. I'm more than doubling my money. Now, where property number 2 does a little bit better than property number 1 happens to be in the area of cash flow. In other words, the amount of cash flow that I'll retain every month that goes into my pocket that I can spend on anything I want, like my expenses of living, which will help me get to a place of retirement. That dollar amount is $364, which represents an annual income of $4,368. That gives me a cash-on-cash return of just shy of 20% cash-on-cash. Now, remember, property number 1 was only returning just slightly over 14% cash-on-cash, but property number 2 is returning almost a 20% cash-on-cash. So I'll tell you what, let's kind of analyze these two properties based on the fact that we're going to buy both of them. So how much total equity would we capture in these properties if we bought both of these properties? And we would capture $54,500 of additional equity in the properties, and we will have only spent up to this point $39,500. That gives us a return on capital gains between the two properties when we blend it together of 141% return on capital gains. That's more than doubling our money. When it comes to the cash on cash returns, what we're getting effectively is a 17% return cash on cash. And you can do the math yourself. You're taking $207, you're taking $364, you're adding them together, you're annualizing it by multiplying it by 12, and then you're dividing that number by $39,500, the amount of money we're injecting into the deal. And as a result of that, we're getting about a 17% blended rate of return off of just these two properties. But there's a third property. Remember, I said we have $50,000 to spend, and we have not spent all $50,000 yet. We've only spent $39,500. So there's the third property that we can buy, which is in Springfield, Missouri. It was built in 1932, so it's in between the other two properties as far as age. It's a 2-bedroom, 1-bath, 720 square foot property. So size-wise, it's similar to property number one, but location-wise, it's about 1,500 miles away, right? Okay, so in Springfield, Missouri, a 2-bedroom, 1-bath that's about 720 square feet when all fixed up trades for about $120,000. And we can buy this property because of deferred maintenance for about $58,000. So we're going to spend about 48 cents on the dollar. So by buying all three of these properties, I am still keeping my cash acquisition purchase price to less than 50 cents on the dollar. I like that because that gives me plenty of money to work with all of the equity that I'm going to capture in these properties, and allows me to utilize that equity to fix these properties up. Now, rehab-wise, on property number 3, it's actually in a little better shape than the other two properties. I'm estimating it's going to take $28,500 to do the rehab work on property number 3. And property number 3 really doesn't require it being upgraded to a 3-bedroom, 1-bath, or a 3-bedroom, 2-bath, or a 2-bedroom, 2-bath, because there are plenty of properties in that neighborhood that are 2-bedroom, 1-bath, and some of them are rental properties, so there's no reason to increase the square footage of this property. So when we look at the cash out of pocket that's required to buy this particular asset, we're only spending $10,500, which when we add it to the $39,500 we're spending on the other two properties, we're right at our $50,000 threshold. So for $50,000, I can buy not one, not two, but I can buy 3 properties in 3 different locations, and they do great things for me. Now, when I look at the return on capital gains on this particular asset, I'm going to capture net equity of about $23,500. And when I divide that by the $10,500 that I'm putting into the property, I'm getting a 224% return on capital gains. What does that mean? I'm tripling my money. Now, keep in mind, these properties are located in different parts of the country. What you are trained to do as a Lifestyles Unlimited member is to analyze those different places and to understand which parts of the country have the potential to give you the types of returns you're looking for and which parts of the country do not. If you held these properties for a total of 5 years, they would produce $47,820 in cash flow for you, and that assumes they don't go vacant over the 5-year period of time. It also assumes we haven't raised the rents. Does that make sense? So it's just the standard rental amount in year 1. We continue it all the way through year 5, although that's not how we will actually operate our properties. That's how I like to analyze my properties. So given the fact that we're making $47,820 over a 5-year period of time, and we've injected into these properties $50,000, our return on cash flow, our cash on cash return, works out to be almost 96%. A 96% rate of return just on the cash flow. So I think the cash on cash, just the cash on cash alone, should be enough for you to understand that the real estate is a better investment vehicle than investing in the stock market, because you're getting a 96% return just on the cash on cash. But that cost associated with fixing the property up, as well as the closing and holding costs, as well as our actual cash out of pocket expense that we expend, is not equal to what the after repair value is. There is a difference between the after repair value of these properties, all summed up, and what we actually spent. So what we're going to do is we're going to capture net equity in all three of these properties of $78,000. We're getting a 169% return on the capital gains. Now, another way that we make money in real estate, properties go up in value. There is something called natural appreciation. And one of the things that we have learned through our research is that properties tend to double in value every 20 years. So when you look at all of the appreciation that we're able to obtain year over year over a 5-year period of time, these properties are set to go up in value approximately $86,000. When you compare that to the $50,000 that we put into these properties, you're getting a 173% return on investment. Now, another way that we make money in real estate has to do with something called principal paydown. Now, principal paydown occurs when you make your mortgage payment on your property. You're going to make a principal and interest payment, and like I pointed out on yesterday's show, the interest is a business write-off. The principal is not. The principal is not a business write-off. However, the principal does pay down your mortgage on the property each and every month. And as a result of that, my analysis says that across all three properties, you're going to get a fairly significant principal pay down on the property. I didn't actually do the numbers because I'll just be upfront and honest with you and tell you that this is the one way out of all 5 ways that we make the least return on our investment. But my number indicates about an 11% principal pay down across all 3 properties. So it's actually keeping pace with what your money would do if you put it in the stock market. The final way that we make money in real estate that you don't necessarily make in the stock market has to do with the tax advantages that we're afforded as real estate investors. The opportunity to take advantage of something called depreciation. Uncle Sam says that my properties are going to wear out over time. And there is some logic to it. Take the value of the property less the land costs. You cannot depreciate the land costs. And in doing so, what I'm able to do is take that number and divide it by 27 and a half years. And that gives me a number called depreciation loss. Now, it's not really a loss at all, but it's a loss that I am authorized and actually required to take on my taxes. And what that does for me is it protects all of the cash flow that I earn on my properties, and I ultimately don't pay any taxes on the cash flow because the depreciation covers it all. So when you take into account the 5 different ways that we make money in real estate, the cash flow, the equity capture, the natural appreciation, the principal pay down, and then the tax advantages associated with being a real estate investor, this particular asset is poised to turn $50,000 into $224,000 and to give me a 369% return on investment based off of all the different ways that I make money in real estate. I will tell you, it's a game changer. 369% return on investment over 5 years versus 60% return on investment over 5 years. Which would you ultimately choose? Now, choose wisely, because if you choose poorly, it's going to take you some time to recover from the problems that you created by making a poor choice. Look, if you want to do what I'm doing, you want to do what the 50,000 members of Lifestyles Unlimited are doing, all you have to do is go to lifestylesunlimited.com. When you get there, the first thing I want you to do is I want you to sign up for a free workshop. That free workshop is essentially the keys to the kingdom. It will get you to where you're trying to get to. So go to lifestylesunlimited.com, sign up for that free workshop, and let's get you going.
The information and opinions you hear on the Lifestyles Unlimited Real Estate Investor Radio Show are those of the hosts, guests, and callers. The Lifestyles Unlimited Real Estate Investor Radio Show is for entertainment purposes only. Please consult a professional regarding your personal investment needs. Nothing presented constitutes an endorsement, recommendation, offer, or solicitation to buy or sell any product or security.